most people at brokerage firms won't like me saying this, but if you're licensed, it doesn't mean you have a level of experience or knowledge. A license is simply a license to sell somebody something. Securities, insurance, mutual funds, ETFs, whatever it is. It's a license so that the SEC says you passed a test that says you know what you shouldn't be saying. That's all it says.
Hey everybody, welcome back to Next Mile. I'm your host, Kyle Van Pelt, co-founder at Milemarker, and today I am joined by Richard Alt. Richard is the CEO of Carnegie Investment Counsel, and this is a man that owns golf shoes, but he does not own golf clubs. Richard, thanks for joining the show.
My pleasure, Kyle. Thanks for having me on your show.
Of course, happy to do so. So I love to ask everybody the same first question when they come on here, because I really want to get to know my guests before we dive into the conversation. And I've found now with over 100 of these conversations on air that everybody has their own unique path to this industry. Some people is a very traditional path where they followed in family footsteps. Other people didn't even know this was an industry that they could work in. And so they came in through the side doors, I like to say. But whether your path was traditional or untraditional, everybody has what I call a money moment. It's a moment in your life where the light bulb clicked and you decided, this is it. This is what I want to do for my career. So for you, Richard, what was that moment that led you sitting in the chair that you're in right now, having this conversation with me?
I would call a money moment was when I went to in 1998, the Schwab Impact Conference out in San Francisco, and I was a wholesaler on the other side of the table. And I got to meet all the smart, bright people on the other side of the table and realize those are the smart guys. They're the ones actually managing the money. They're the ones hand-holding, doing the right things by clients. I wanted to be on the other side of the table. And within probably 18 months, had made the flip from working for a large insurance company to working as a small investment advisor.
Wow. So you were wholesaling insurance then into advisors?
Yep.
It's a great place to get your start in this industry. I feel like a lot of people have started on that side of the business.
Yeah, my wife still thinks I should be on it because she loved the high salary. But going from that to no salary at all with 3 young kids wasn't her idea of a good idea.
Yeah, I could see that. It's a little bit of a risk. Okay, there's a story that I saw on a video of yours, and I think it's a kind of an extended money moment of yours, but it's about your grandmother. And I don't want to lead the witness too much, but I'd love for you to tell the story about your grandmother and how that kind of inspired you to do great work in this industry.
My grandmother was straight from Sweden. My mother was even born in Sweden and came over when she was like a 2-year-old. But my grandmother worked as a maid for a very successful gentleman who ran a publicly traded company. And she was one of several housekeepers kind of maintaining. And this is in the 50s and 60s. And part of her compensation was individual stock from Mr. Thompson, which eventually became TRW, which eventually got bought out by Northrop Grumman. But Mr. Thompson compensated her with, I think he actually told her what to buy, and it was Thompson, TRW. And through the years in the 60s, that small savings that she did, and she never made, I don't think she made more than $8,000-$10,000 in her life per year. In her feeble savings, it eventually became worth quite a bit of dollars. In the mid 70s, it turned into a couple $100,000 for her. That was, huge money, and certainly more than she ever expected to have. And she didn't know who to trust. She ended up working with what she thought was a big name brokerage firm. And by the time I went to college, which was in the early 80s, that broker had turned that $200,000 into, let's say, single digits, which the market was in a great time, but it was almost hard to do that. And it was, I just think so much of our industry has unscrupulous people, and part of it is just the structure. I think that if you create an environment where people can make a $4,000 payday versus a $1,000 payday, just putting people in one product over another, you're probably going to do what's right by your family, but not necessarily what's best by the client. And that's the tough part about our industry. We still haven't eliminated the conflicts of interest. But it is that the general idea there that made me want to be a true fiduciary, which is what Carnegie is. Somebody who has no conflicts of interest, does things in the best interest of the client, no soft dollar arrangement or any other kind of compensation other than directly by the client.
What a powerful story, and a heartbreaking story, in that power. It leads me to want to ask you about something that I feel like is a difficult thing to quantify. But when I look at our industry, I think one of the biggest challenges for a prospective client or an investor is figuring out what type of advisor you can trust. Because at the end of the day, most of these firms are marketed the same, they're described the same, all of these types of things. You come in, they talk about how they're going to take your money, they're going to invest it, they're going to do a lot of that. And I think there's plenty of people who will say and promote that this is a noble profession. There's a lot of people who I think are really out there trying to do great work and noble work and helping people achieve their dreams and goals. But like all places, there's still bad actors in our space, but it's very difficult to tell them apart. So from where you sit, for somebody who is considering this, what is the best way to figure out who you can trust as an advisor with your money?
It's a great question, and I've given this a lot of thought over the years. I think it's just a matter of asking enough questions. And unfortunately, people spend more time shopping for a refrigerator than they do an investment advisor to talk to, handle their lifetime of savings. And I still think the numbers are dramatically skewed still towards there's more investment advisors whose income and revenues are based upon commissions than there are on the other side. But I often say to a prospect, if you ask enough questions, you'll end up at a firm like Carnegie. And the first question, and it's just in understanding the business, but are you a fiduciary? And are you a fiduciary 100% of the time? Because a broker can actually be considered a fiduciary on their first trade, but what they do after that might not be making a decision in the client's best interest. And it's just as simple. Are you going to put my interest above your firm or your own income? And that's a significant question. The second is, are you licensed? And most people at brokerage firms won't like me saying this, but if you're licensed, it doesn't mean you have a level of experience or knowledge. A license is simply a license to sell somebody something. Securities, insurance, mutual funds, ETFs, whatever it is. It's a license so that the SEC says you passed a test that says you know what you shouldn't be saying. That's all it says. So it doesn't mean anybody is more experienced. It just means they have a license to sell. I had all those licenses, and I like to joke with people that are at brokerage firms. I say, we have no licenses over here. We do what's in the client's best interest. We're not regulated, and we can actually say what we think and think what we say. So,
well stated. I think that's good. And I think that's a good framework for how to position yourself, how people should pursue this relationship with advisors. Because I think that is, at the end of the day, that is still one of the single biggest things is, can you trust this person and are they trustworthy? And trying to figure out how to put that out. But one way also is how long people have been in the business. And you can only do that, by doing it, right? There's a lot of really well-meaning people who are going to do everything that you just said, who have just started their firm and they're going to make it happen. But Carnegie just recently celebrated 50 years in business. So talk to me a little bit about what that means to the firm and what that means to you.
A year ago, we celebrated our 50th anniversary, and it's been 16 years since Gary Wagner and I became managing partners of the firm. I get the question, did we found the firm? Like, I was 11 at the time, so no, I didn't found the firm. So experience, living through different economic times. We have some people here who are in their 70s who can reference early 70s and when inflation now period. I remember the 87 junk bond market. I remember the 89 crash, and certainly the 5 other recessions between then and now. And experience gives you the ability to put things, I think, in a little bit in perspective. This year, with the new administration, I hear every week some client will say, it's so different now. It really isn't. It's just a different problem set. And now we have some government risk because of tariffs or something, but there is always something to be worried about. There's 6 different levels of risk, and people always focus on the market risk or inflation risk or government risk. Opportunity risk is the one probably the least known and the least understood. But sitting in cash during the last 10 years is a tremendous risk for your money. But experience, time, being in the business for a long period of time, it gives us the ability to, I think, make good long-term decisions and not avoid the other trap of our industry, which is emotional decisions, which undermine any long-term plan.
Well stated. So, okay, you brushed into them there a little bit, but talk to me about the 6 kinds of risk and what you can do to manage them. Because I also think that's a huge part of this is you grow your wealth and you do what you can to grow your wealth. But then a huge portion of this is risk management to make sure that you retain and keep that wealth. So lay out for us the 6 types of risk and then what you all do to help mitigate those.
I didn't know there was going to be a test here. I'm going to have to do my best to remember them all, but we're all subject to these same risks. The simple risk of inflation is if you have $1 million and you put it all in CDs and inflation's 4% per year and you're making 3.5% on your CDs, you're actually, the value of your money is worth less. You're going to be able to buy less in the future than things than you have today. Market risk is obviously the market going up and down and you selling at a bad time. I think of the whole purpose of bonds or cash. This is a very simplistic way to think about it, but the only reason you own bonds or cash is so that you don't have to sell stocks during a bad period of time. So make sure you have enough cash or bonds to get you through a period where if you're withdrawing money out of your portfolio, you need $5,000 a month, that there's $60,000 a year for maybe 3 years to get you through a period where you don't have to sell stocks. And there's obviously individual security risk. You invest in a bad company, you get emotionally tied to a company. I think that's one of the greatest hindrances of individual investors. I've never had an individual investor walk in the door, hand me their portfolio, and it to be properly diversified. And either they have 25 different mutual funds, which is silly because they basically own the entire market, or they have it all in 3 stocks. Like, that doesn't make sense either. It's way too much individual company risk. Bad things happen to even the best companies. My oldest story is I remember probably my 3rd client ever getting into the business. He worked for 40 years at Sears, Roebuck and Company. In the 70s, you couldn't convince anybody who worked at Sears that the company wasn't going to be around for another 120 years. And in a short period of time, it was no longer a relevant company. And I was not a good enough advisor 35 years ago to convince him that he should have sold a big chunk. But the same story happened today. A gentleman has over 12% of his net worth in NVIDIA, a wonderful company, a company we own $80 million worth across our company here at Carnegie. But it shouldn't be more than 5% of your net worth. It just shouldn't. There's just so many long stories of bad things happening to what we think were formerly great companies. And there's 5,000 publicly traded stocks. There's about 40% are profitable, making money. You just need to invest in 35 to 50 and call it a day. You don't need to be committed to 3 companies. And then there's obviously government risk, a government making a decision about something that impacts your portfolios. It's not a concern until all of a sudden a tariff hits one of your stocks. And if it's a foreign company, it's going to have a very large impact. There's international risk, regulation risk. EPA, you own a pipeline and all of a sudden EPA shuts down the pipeline because you didn't fill out a form right or something. Or you own shares of Boeing and two planes blow up and the stock crumbles 40%. Great company. There's only 2 airline manufacturers. How can they go wrong? Well, there's outside risks that can undermine or mitigate it. There's also US dollar risk and other things that we try to build a portfolio to avoid.
Yeah. Well, well done. I mean, I thought it was super interesting that you'd laid out that there was 6 of those types of risks. And then it seems like you had a great approach to how you would manage them. So thanks for sharing all of that with us. I think that'll be insightful for a lot of those who listen to this. Speaking of insightful, I want to talk about, you all just made a sizable acquisition or partnership with Eagle Ridge. So a little over $1 billion in AUM as a firm that you all brought into the Carnegie family. Clearly, they were doing well and they were successful. What made Carnegie a great landing spot for them as they tried to seek out an opportunity there?
Yeah, it's really been a great combination. I think a couple things that made it work, and again, we just closed the books with them January 31st, so we're still in the early stages of the combination. But the one thing that mattered is they had 5 partners that owned the firm, and 2 of them kind of senior that were looking to have more of a liquidity event and retire, and 3 that wanted to stay on. They had the rest of their career ahead of them. It wasn't all about just trying to get the top dollar. They wanted the right firm that's going to continue their investment style and skill set, what they've built over the years. And they actually used an investment banking firm, a very good one, Berkshire Global, who put them in front of something like 32 firms that they had culled that thought they were good fits for them. But it was a lot more about culture. So one thing that was very important to Eagle Ridge is they build portfolios kind of the old-fashioned way, individual, very custom. They have a couple models, but each individual portfolio is a little bit different depending upon income needs or risk tolerance or size of the portfolio. And both Eagle Ridge and Carnegie are a little inefficiently managed. We have a low number of clients for every advisor. It's not the most profitable system, but it's the right system, I think, when you're managing high net worth individuals' funds. They ended up doing a tour of 3 firms. Ironically, all 3 firms were in the Midwest. They came out and visited us last July and ended up in September saying, we want to make it Carnegie. So we're very fortunate that they chose us. They've started in December assimilating into our investment committee meeting, and it's been great. I really think they've added some things that we didn't have. They had several CFPs, certified financial planners, that broadened out our depth. We have 5, but we had greater need for more. And I know our office in Los Angeles has used them for a couple cases already. So they've been a great piece of the puzzle, and I think it's going to be a great long-term partnership with them.
That's excellent. Thank you for sharing that. So one thing that we found when researching for this conversation is there was a quote by you on transitioning a firm like Eagle Ridge or integrating them or something along those lines. And the quote, as we found it, was, "Successful transition isn't that hard. It is about great communication. It's knowing upfront what the expectations are, and it's communicating to the clients where we're going together." So we have a bunch of people who listen to this who've probably had a different experience with that. You clearly did a really wonderful job at those 3 things. But what did you do with such a big monumental change like this to ensure that those 3 things, communication, expectation setting, and then communicating with the clients? So I guess communicating internally, communicating externally, and then expectation setting. What did you do to ensure that those things happened?
Kyle, I think it's helpful that we've had some experience doing some transitions. So Eagle Ridge is really our 10th, 11th maybe merger. So we've learned a little bit over the years, and it's still about the people, right? So Mindy Mackey runs our marketing, but communications, and just everything from the messaging that we were doing to them early on, specifically with their clients. We wanted to make sure their clients heard 3 things. 1, their fees aren't changing. 2, their investment advisors are still going to be part of the team. Their custodian wasn't changing. And what we were bringing to the table was just simply more depth and confidence that there's going to be a next generation for Eagle Ridge. It's just going to be called Carnegie, but really the entire team came over. There was nobody took a step back. Everyone has a position moving forward. And it just gets back to having great people being able to serve in these roles of communicating to the client, to the team. Just on Sunday, we have 2 people going to Stanford from our operations department just to spend a little more time with them that Zoom and these type of technology is wonderful, but doing it in person, there's nothing better.
I agree with that wholeheartedly. Out of those three things, so I love hearing you share your experience from more than, it sounds like now, a dozen transitions or things like that. But those three things that you said to make it successful, great communication, upfront expectations, and communicating with the clients where people are going. Which of those, in your opinion, takes the most intentional effort to get right and to do it well?
I guess it's really communicating with the team. I have to admit, I'm somewhat mimicking the experience. We brought in the Ritz-Carlton team a few years ago for them to explain their white glove service. And the first thing they basically said is, client's not always right, but if you treat your team players, people that work for Carnegie well, it's going to reflect to the clients, and they'll high level of service, especially because that's all we are. We're a simple little service. And the value of Carnegie walks out the door every day, which is frustrating for the bankers. The bankers, when we try to borrow money, they're like, there's nothing here. And they're right. But if we treat the Carnegie team, who works day to day handling all the clients' issues and concerns, if they're happy, they're confident, it comes through in the conversations. It's the reason why we put a premiere on, I think, obtaining the best people out there. And we're somewhat known to pursue great people not in our industry, but bring them over our industry, and we can teach them the business. But you can't teach concerns and drive and niceness that comes through working with what I think are great clients.
This podcast is brought to you by Turncast. We make game-changing content for fintech and financial services companies. Learn more at turncast.com.
Hey, this is Judd Mackerel. Thanks for listening to this show. I just wanted to ask you one question. What's your technology and data strategy for 2025? If you can't clearly answer that question, I'd love to talk. We are spending some specific time with select firms to really go deep and help you clearly answer that question. We believe that it's one of the things that often holds back firms from really achieving their potential, from really achieving growth, and really getting a lot of the things in the position that they need to be. The things that are holding up the way that you scale, like your workflows, how you manage data around your revenue, how you report all that to your advisors, and getting clarity in all those things. I'm sure there's a lot of very specific things to your business that are really important as well, and we'd love to talk about that. If this is interesting to you, hit me up with an email. My direct email is jud@milemarker.co, and I'd love to hear from you, hear what you're working on, hear what your strategy is, and see if there's an opportunity for us to help you get more clear on that strategy in 2025. Thanks.
I'm going to ask you something out of personal curiosity. So it strikes me, the name is Carnegie Investment Counsel, one of the titans of industry from early American revolutions is Andrew Carnegie. Was that just inspired by him and what he accomplished? Is there any relation? Because I know that you all obviously named this much later, and I know you kind of were there a little bit later, but I'd love to hear what part of the story that name has with this.
I'm just glad you didn't ask me how to pronounce it properly, because I'm not sure I know. In Pittsburgh, it's Carnegie, and I think we say Carnegie. I'm not exactly sure, but you may need to edit my answer to your question. The firm was founded by Prescott Ball and Turbin, which was the largest brokerage firm in the state of Ohio in 1974. And their offices were right downtown Cleveland. And they decided to put together this boutique money management firm. And the lawyers wrote up the legal document. They didn't know what the name was going to be, so they just filled out, they kind of made up a name. There was just a part-time purpose until the partners decided what the name of the firm was going to be. So they called it Prescott Capital Asset Management Company, which Prospect was the name of the street that Prescott Ball and Turbin was on. And the managing partner at the time said, you got to get Prospect off of that, because Prospect in downtown Cleveland was known as the road where all the hookers were.
Oh, no.
So the parallel street to Prospect was Carnegie Avenue, and they just threw that name on there. And it's been that way ever since.
Wow. I'm so glad I asked. It's amazing how these things happen. That's hilarious.
Yeah, it's nothing to do with Dale Carnegie or Andrew Carnegie or No, it was that long, clunky Carnegie Capital Asset Management Company from 1974 until 2009. And Gary and I made it just Carnegie Investment Counsel to be a little more clear what we do.
I love it. I love it. Okay, so you have done all these wonderful things. You've talked about the service that you offer. I think that's fantastic. Milemarker is a technology company. I love to ask people like yourself about how you're leveraging technology as you grow and as you think about growing. So talk to me about the role that tech has played in Carnegie Investment Counsel's story so far.
Tech is very important. I think we've got a state-of-the-art tech stack in terms of portfolio software. And, we can do things today that we couldn't do 30 years ago. Just with Bloomberg's today sitting in our office, we have all the data that you would have sitting on Wall Street. But tech has really helped us also be able to, and going through the COVID period, is the ability to maintain relationships no matter distance. We literally have clients in all 50 states across the country. And sometimes you can't get to everyone everywhere, but people are very comfortable using Teams or Zoom to reach out. I think tech in our industry is very well used. It does have its limitations, though. I don't believe at all. We get the question often, do you think your job is in jeopardy because of AI or these betterment services that you could have one person manage an ETF portfolio and you have no longer a job? That's not what we do for a living. Our job is not just picking stocks and putting them in a portfolio. It's managing people. It's managing risk. It's hand-holding clients. So many of our relationships are people that they're experts at their fields. They're surgeons, they're accountants, they're architects, but they don't want to worry about this. They don't want to follow the market on a daily basis. They don't want to make decisions. Some very brilliant clients in their own particular fields, but either they want us to take care of their family or their spouse, or the number one source of clients we actually get, obviously referrals, but it's actually former self-managers. I find it interesting. It's my personal belief that everybody eventually capitulates. Schwab and Vanguard and Fidelity Betterment give you all the tools, and it's very easy to self-manage. But then you got to actually do it, and you got to make some real-world decisions. And if you don't have a huge ego, you realize it's a little harder than you think, and nor should you, which is just a lesson I've learned the hard way over the years. You shouldn't manage your own money. Here at the firm, I don't manage my own IRA and nor my wife's IRA. There's other portfolio managers here that do it, but you just make decisions, good and bad, that are probably inappropriate when you're managing your own funds. Either you don't pay enough attention or you take just simply too much risk. And technology has the ability to really improve data and communications and just portfolio design, but it never is going to be able to take away that human element, looking across the table from somebody and saying, am I going to be okay? And that's what we do for a living.
That's so succinctly and well stated, that last statement, because I think about that often. And I'm not an RAA, but I have the privilege of spending a lot of time with them. And I think so much of the conversation is around opening accounts and RMDs and this is all stuff you have to do. But at the end of the day, it's like clients are coming to you with their hopes, dreams, and fears, and they want to know, are they going to be okay? And you're one of the few people on the planet, probably outside of their family or something like that, where they're really sharing all of this raw desire and fear and emotion. And it's like, can you help me be successful? And I think about that a lot with the AI stuff. I think AI will make things incredibly efficient. It will remove a lot of the tedious work, but I am skeptical that people will trust AI with their hopes, dreams, and fears when it comes to those types of things.
You're right. The conversations we have are very unique. Just in the past 2 weeks, it's two different clients, and so one lady inherited $11 million. She's not talking to her neighbors about it. She's not talking to her coworkers about it. She's asking real world questions of things that she should be doing on trusts, on wills, on gifting, on college savings and stuff that she doesn't want to Google all these answers. She wants somebody with experience to be able to answer these questions and sometimes argue back and forth. And that makes sense, but maybe there's a better way to do things. Just simple stuff like Roth conversions. You can Google it, but then it's different for somebody that has $100,000 than somebody that has 2 million. It's just, there's just different factors in place. So the very simple decision of whether or when you take Social Security is different based upon your assets. So I'm not worried about that at all.
What are you worried about? So I'm going to ask the question that way. I tend to like to ask my guests to kind of look into the future and make some predictions, things like that. But maybe I'll phrase it a little bit differently and say, because we've already talked about AI, we've talked about technology a little bit. So for you, what are some of the things that do have you worried right now about growing a company at such a nice clip?
It's a very similar theme that I've heard across the industry, just finding enough advisors. We're fortunate we're in a situation where we have a steady flow of new clients walking the door. It's getting people who are driven and interested in the business that want to be here. Recruiting people from outside the industry, I think, is our biggest source. And it's something that I've done it a couple times that is paramount. We have a new advisor coming on board at the end of the summer. She's been a client for 10 years, works at a private school, and is really talented, very strong, confident person. But working in administration of a private school, her income is capped. She's one of the highest paid people there, and she's got no place to go. And I think in our industry, she could triple her income in the right situation. So we've had to recruit her in from an outside business. So the only other answer I could think of off the top of my head is I do worry that after a lifetime of being in this business thinking, eventually commissions would go away, that they're still here. I just don't understand why the SEC can't figure out a way to eliminate these terrible conflicts of interest that we have.
Well stated. I think it is an interesting conversation point on both of those, but I think that everybody is talking about the advisors retiring, or we have this top heavy amount of advisors. I don't know if there's enough conversation. Maybe there's an ample amount. I don't know if there's enough conversation about getting people in. And it's cool to see these universities with financial planning programs now. There's education happening there. It seems like people are getting interested in the space. But I have talked to more than a handful of people where they're saying there isn't enough advisors to serve all the people. And I also find that fascinating, by the way, because one of the other huge topics of conversation is that firms really aren't growing that much organically, right? The average organic growth of a firm is 2 or 3%. And, it almost seems to me somewhat of a supply and demand conversation. Hey, why are we going to push the organic growth even higher when I already don't have enough people to serve all of the ones coming in? So that is an interesting problem that I'm going to be interested in following how it evolves over the next couple of years.
It's actually a good problem to have, right? We have enough business out there, and the trajectory of the RIA space just continues to grow dramatically. I think like a company like Charles Schwab has tripled their custodian assets in the last 8 years or something like that, where Merrill Lynch is the same custodian assets they've had for 10 years. It's a great business. You're dealing with great clients. If they're pains in the ass, you can self-select them out, and having interesting conversations with successful people, it's a wonderful occupation.
All right, Richard, we are going to move into the final segment of the show, which is what we call the Milemarker Minute. So this is a series of lightning round questions aimed to be lighthearted, getting to know you a little bit better before we wrap up. So are you ready for the Milemarker Minute?
I am set.
Okay. If you could travel anywhere in the world that you've never been to before, where would you go?
I guess I would say Australia. I've just never made that big travel. It'd be a long, long flight, but I'd love to go there someday.
Okay. Are you a mountains person or a beach person?
Total beach.
Beach. Okay. Just follow-up question. Favorite beach that you like? Do you have a place you like to go?
Yes. Sanibel Island, where I have a house.
Love it. Excellent. Okay. What is the best flavor of ice cream?
Clearly chocolate.
Okay. 1 year from now, you are celebrating a monumental win with the people closest to you in your life. And you guys are all sitting at a table. What meal are you all sharing to celebrate your huge win in your life?
We're sitting at the Marble Room in downtown Cleveland in the private vault room that has great food and great service.
I love it. Fantastic. Off air, before we started the conversation, you were sharing with me that you are trying to get to a majority of the Major League Baseball parks with your sons, and you try and get away every once in a while. Cleveland Guardians fan. What is the one park you haven't been to yet that you are most excited to go visit next?
Dodger Stadium. I've heard that's just a beautiful ballpark. I've actually been to Angels, but we never made Dodgers. So, and they're such a very, very good team. So it'd be fun to get there.
I can vouch. It's an incredible place. I'm excited for you to go check it out. What is the best book you've read or listened to in the past year?
It's actually right here. Good to Great by Jim Collins. Yeah, yes. I've read it before, but it's a book every 3 years I need to read and just remind myself.
I love it. Okay, my last question for you. True or false? We will have a $1 trillion RIA within the next 5 years.
False. Not 5 years. I think it'll happen, but not 5 years.
Okay, great answer. Richard, thank you so much for coming on the show. You were a terrific guest. I think you shared some wonderful insights about the ins and outs of running a growing business, what it looks like to acquire a firm, using technology, and what we should be fearful of or not fearful of. So thank you so much for sharing your insights today.
My pleasure, Kyle. Thanks for allowing me on your program.
Of course. All right, everybody, that's been another episode of Next Mile. Thank you so much for tuning in. Please make sure you click follow or subscribe wherever it is that you're paying attention to this. And if you'd be kind enough to leave us a review so that people who've never heard of this show can find great conversations like the one I just had with Richard. But until the next episode, enjoy every mile.